Well, stocks currently looking positive across all three major indices right now, with the Dow up more than 200 points. Is a relief rally on the horizon? Our next guest thinks so and says the S&P could make its way back to 4,300 by April. That is barring outside factors. Joining us now is Barry Bannister, Chief Equity Strategist at Stifel. Barry, we could all use some positive news after the last month that we've had. Certainly, we have seen gains pick up over the last few weeks on this expectation potentially of a Fed pivot. What are you watching right now in terms of the levels that will really, you think, could push things in the right direction?
Well, you know, a lot of the bad news was known, and we had a violent sell-off in the first 10 months of this year. If you look at the nominal peak of the S&P 500 index, it was 4,800 on January 3rd, but the real inflation-adjusted purchasing power peak was 5,100 on December 29th. So we fell about 31.5%, which if you look at the 14 bear markets since 1947 in the post-World War II era, really, the 14 bear markets associated with recessions, the average and what we call the trend mean, taking out the highest and the lowest, was 31.7. So we had a bear market, a vicious, mauling bear market due to Fed policy. But when we analyze all the fixed income, currency, futures, political, economic, geopolitical factors, we come up with the view that if the Fed is not turning the dial to tighten every single day, that's effectively a second derivative easing. In other words, not raising the volume is a form of lowering the volume. And I don't think the Fed gets tighter than what's embodied in futures. In fact, I think futures are probably overstated in May of 2023 at nearly 5% on short rates. Inflation is going to come down. Any first-year economics student in college could do what we did. All you do is break down inflation into its subcomponents, and all of them point down. All of them.
So, Barry, does that mean that you're in the camp that you think the Fed could potentially pause some of these rate hikes because you think that inflation is starting to show some signs of moderating and that the Fed can't move too aggressively?
Well, we look at GDP, right, on a quarterly annualized. So we take the most recent quarter, we annualize it, multiply it to the fourth power. We annualize GDP. Well, let's annualize inflation. So CPI inflation for the 3 months ended September, annualized, was only 2%. Yes, it's 2%. So the momentum of inflation has already turned down. If you take the core, it consists of services, and that is shelter services. So that would be housing related. Those are already turning down. Yes, there's a lag, but they are turning down decisively on rents, home prices. You saw the data today. You look at non-shelter services, wages are the key driver. And wages such as the Atlanta Fed wage tracker and average hourly earnings year-to-year change, and hopefully on the 28th, the employment cost index, all point down. So again, you have to steer the ship with a long lead time. The Fed knows that. And they've done their job. They flattened the curve. By end of year, the curve will be completely flat, if not inverted in some points, obviously, 10 to 2s. But as they do that, we have to be ahead of that. We have to think, okay, well, the Treasury is worried about bond market liquidity. Treasury Secretary Yellen, former Chair Yellen of the Fed, made a statement yesterday. The Treasury is intently focused on bond market risk due to liquidity and other concerns. So if the market is always ahead of reality, we have to get ahead of that. And so it looks to us like there'll be a rally October to about April. I wouldn't overstay the rally. There are a lot of tail risks later in 23. But again, the market is always looking ahead, and we're trying to keep up with it. And I admit it's a really hard job.
So, Barry, you mentioned some key risks there that could derail that upwards climb to 4,300. One of them being oil shocks. What's the big concern there right now?
The G7 and the West collectively are desperately trying to establish what's called a buyer's cartel on Russian oil. And naturally, and you can't blame them, OPEC Plus, which is OPEC's many member states plus Russia, They don't want, with their sellers cartel, to have a competing buyers cartel. So they're not cooperating, and they shouldn't cooperate. That would just be illogical to expect them to do so. So the early December, there is this planned cap on Russian oil. That could create tremendous volatility. Russia has a lot of avenues. I personally would be thinking they might target the CPC pipeline out of Kazakhstan to reduce flows without cutting their own production, to drive the price up. And if oil rockets higher, oil is at the core of inflation. This is what the ESG people never understood, that all GDP is the conversion of energy. And because of some of the dragging risks on GDP growth, demographics, debt, we don't have the kind of growth we used to have. And as a consequence, we need cheap energy. And so more expensive energy is not going to solve this problem. So if energy goes up, that's the core of inflation. That drives everything, including core CPI and core PCE. So we don't need an oil shock. And that's the risk here. You know, I remember the 1970s very well. We had a 73, 74 oil embargo. And then in 79, we had a second oil shock due to the Shah of Iran falling in Iran. We don't need that. And so geopolitically, I think we've got some very poor diplomatic policy out of Washington. And hopefully they don't drive us over the edge with a secondary oil shock, having already depleted the strategic petroleum reserve.
Stifel Chief Equity Strategist Barry Bannister, it's good to talk to you today. Appreciate the time.
Thank you.